All right. Good evening, guys. Ken at Tortoise Capital. It is the nightly strategy podcast for September 9th, 2021. We'll jump right into it with the market health check. You can see the 30-day low, and we've had an uninterrupted move, really, from the last time there was a micro sell-off. Tested the bottom of the dragon, gave us leg one, then leg two, and now we're in a 4-day sell-off that has pulled all the way back to the PSAR flip, or to the PSAR. It hasn't flipped yet, I should say. We're working on, there's a COTA 2 entry. This could have been a COTA 2 if this move had gotten you out, and it should have. You could have gotten a 1, 2, 3 entry here, or a COTA 2 entry up in here when it breaches through the dragon. You get the PSAR flip a few bars later, and then an official COTA 2 where the RL10 has now left the river. This is the point where trending behavior has begun again, because you'll notice that when the RL10 comes out of the river, right in here, that's the moment when you get officially a return to trending behavior, which is when the price and the RL10 and the RL30, which is here, are all out of the river. So that was the case back here. We had a little bit of trend right here where the RL10 had come out of the river, and then this is all upward trending, because you'll notice they all stayed out of the, the RL10 and the RL30 stayed out of the river. So that trend lasts until it breaches back into the river here. So the RL10 comes back in the river. The RL30, which is the health of the trend, stayed out of the river the whole way. So this is still an upward sloping trend. But you'll notice that the RL30 is starting to roll over. I wanted to show the difference between the previous projection and where the RL30 is now. So you can see that's beginning to decay. All right. And now the RL10 is within, probably one more day, and it'll come back into the river at this rate. If we got a significant sell-off tomorrow, then the upward trending behavior is over. So this really is what I would consider to be a critical state in the health of this particular trend, right? And so let me zoom in on that a little bit more. So the RL10, as you can see, has now turned from summer to fall and is decaying. And as soon as that gets back inside the river, then the trending behavior is over. It's still the bias is up because you have a positive slope in the RL30 and it's out of the river, but the RL10 will have weakened enough and joined the price back in the river, and that would be the end of the trending behavior, which began way back here when the RL10 came out of the river and rejoined price and the 30. So we're now right at the PSAR. It's a little over halfway from the swing high back to the Bollinger Band mean. And so this really is the critical state right now. We're going to see some signals generating, but to me, this is kind of this is the crucial moment right here on this trend. Is it going to recover out of this sideways, and become just a sideways grind at the new price level? Or is it going to take this as an opportunity to make gains? Or does it fail below the PSAR and come back to the Bollinger Band mean? So really, what it does tomorrow then is going to kind of be crucial. You can see that the Hull 3 period is pointing downward, so that's where the the most recent urge or surge has been is down. And so if that just continues to follow the hull, this thing's going to just keep looking like this. If we just drew the parallel lines through there, then we would expect this tomorrow to close somewhere around here. That would be a perfect continuation of the weakness in the hull. So we would be not surprised then to see a price around that's going to be about 448. Yeah, 448. So that's what it looks like for tomorrow. Now, if it violates below there, then that's an acceleration to the downside. And then you can see it would violate the 10-day low at this red line. So if you're a intraday trader, the break at 448 is where you would get a second position in, right? And then if it broke below, let's say the 10-day low, and or the Bollinger Band, that's really, I think that's the same price region. Then that's where you should be having 3, and then the next price level is the 30-day low, or this is the 2.5% sell-off right here. So I think that's where I would be looking to add a fourth position. So all of these would be, you'd have 3 positions short in that region. You could get your fourth position on there, and then it's Katie bar the door. Because that one violates this belly of the dragon. That's a collapsing dragon right there off of the, it's simultaneously the bottom of the dragon and the bottom of the RL10. So this price level here at 442, that would be decisive. That would be hugely important. And then on a longer term basis, that's where this feels like a not just a tactical trade anymore. This feels more like a big move down. That's where the big move down starts. And then if it falls out of the river, out of the floodplain, really big problems, all the way down to the Z3 at 431. Now, if everything just went along with the hull, the way this thing has been failing lately, you would expect the decay, the fail, to kind of parallel that hull at that rate of failure. But the more and more these support levels were to collapse, you would start to see this kind of phenomenon over in here, where you get failure and then it accelerates, as opposed to the slow grinding that happens on the way up. This is where it's fallen out the window. So if this thing were to fail and get all the way to the Z-3, it wouldn't take all that much time out here. This thing would probably fail in 5 or 6 days and get that really huge surge. So that's the downside cascade that I would not be surprised to see. I will be prepared for it. I wouldn't be surprised if it happens. Now, to say that I wouldn't be surprised doesn't mean that I think it's a high probability event. It simply means that the probability is sufficiently large that if it happens, it would not be an anomaly. It would just be an extreme, normal, downside accelerating sell-off. And remember, a move to this level here, to 431, that's only a 5% sell-off. And that's where people would begin to say, oh, well, we may be in for a correction. Well, I'll tell you what, in my view, if this thing fell that far, from the swing high all the way down to here, if that's not a correction, I don't sure I understand what that word actually means. So be careful about accepting the easy, simplified explanations of the commentary class, trying to calm people's nerves to keep their money in positions while at home they're sweating. They're sweating it out in the portfolios with the actively trading hedge funds and all that stuff. So to me, this 2.5% sell-off is kind of where things really start to get seriously bad. And by that time, if this were to fail, I want to have those 2 and 3 positions in and maybe the 4th position and have a swing short. Meanwhile, everything in here I consider to be like tactical trading. This would all be tactical trading inside here where I'm exploiting short-term weakness, which is just coming back to the Bollinger Band mean and a little bit further. But once it breaks below, I think right about here, this is where I would just say, oh, this would be really bad for price action. I think it'd be something like this. So that's what the downside feels like, and now I have visualized my strategy with a couple key decision points, and it's informed by statistics and price support levels and understanding what it's done in the last 30 days. Now, to the upside, I'm also going to say that it has now fallen sufficiently far that I don't have any quarrels with getting long inside of this space, because now the recovery from this routine sell-off, which is about 1.5%, could be really good. I would expect it to take probably that long to get back to test the swing high. It probably takes 4 or 5 days to recover. And where I really get excited on the long side would be, again, if it breaks out above the all-time swing high. I would be willing to also say if it broke out above the peak of the RL10. So let me pull this down a little bit here. That's probably where that's really, if it breaks above here, that's where I'm really excited longer term, right? Yeah, that's where I get very interested, and that will have left behind all of the concerns about the sell-off. So I really am keying that to the top of the dragon and top of the RL10. Actually, top of the dragon and top of the RL10. So that is my operational graphics, my control measures that are describing the bias I'm going to feel on the basis of where price is. And so I'm doing that now before price is moving so that I can construct the appropriate deliberate response to price in certain regions instead of waiting to see it happen and then try to react in the moment. I would much rather visualize that now, decide what actions I want to take or which way I'm leaning, and we would think of that as scenario-based training. So that's part of framing the market conditions, which are responsible for about 50% of the gains or losses of all the instruments that I trade, which are strongly correlated to the market. So if I can get this piece right, then half my job is done. Okay? Everybody clear on that? Any questions? If so, drop them in chat there. And otherwise, we'll drive on. Let me know if you found that to be helpful. Okay. All right. So let's shift now to the sectors. So the worst performing sector today was the S&P out of our 6 broad ETFs. and it was down 0.43. The diamonds were slightly better at 0.4. The Qs were a little better at minus 0.34, emerging markets 0.19, and then the Russell was basically flat at minus 0.05. So all the equities were weak today. And then the one thing that was useful or helpful was the treasuries, who have recovered from their test of 145 area and are almost back up to 150 with a nice day of 1.21. So it took 4 days of selling in SPY for the treasuries really to begin to get the juice. And that tells me that there are people now posturing toward the defensive plays as they start reading that market. And that's big money that is posturing. They want to have positions already in place that are protecting themselves before they even start talking about, oh, this is a correction and so forth. Like, they're not going to wait for a 5% sell-off to start taking hedging action as if 5% was the beginning of a correction. They are really acting as if 2.5% would be the beginning of a correction. It used to be the common wisdom that 10% was the sell-off, but you can already see some hedging behavior in evidence in the relationship between the sectors and the broad market. So let's take a look at the things that were better than the S&P today. We'll just start with the sectors. So we had Mexico was 0.02, materials 0.04, energy, finance, biotech, ARC innovation 0.45, ARC genomics 0.5, moonshots, blockchain, clean energy 0.8 to 0.9. Lithium, 1%. Oil exploration, 1.25. VIX as a hedge was becoming more costly at 2.12. And then you have Brazil at 3.25, and the large cap blended crypto, people starting to buy back after the big sell-off to erase the premium. They put that premium right back on with a recovery of about 13%, which is interesting because the Bitcoin and the Ethereum trust did not have that same kind of behavior. So you're seeing a separation now between the broad crypto ecosystem and then the two majors, the two leading by market cap, the Bitcoin trust and the Ethereum trust. You're starting to see some separation by style and size. Now the individual companies that did well. So Alcoa, almost 4%, Robinhood 3%, U.S. Steel 1.1%, Virgin Galactic 0.9%, Devon Energy. So Devon Energy was a good trade for us yesterday intraday, and today rebounded nicely along with strength in the energy sector. Cliff in the metal space, PayPal, the disruptor, and Tesla. So there were some choices out there today that resisted the late afternoon sell-off and the decay in the S&P, which closed poorly. All right, so let's take a look at the downside to see what were where were the weak areas that were contributing to the general underperformance of the equities today. Well, we have the two lumbers at minus 0.44, the FANGs at 0.47, consumer staples, I should say, 0.6. Wheat and precious metals, 0.68. Blended commodities, 0.73. Agriculture, 0.85. Commercial real estate, minus 1.1. Oil, minus 1.73. Marijuana, 2.5. Ethereum, showing weakness at minus 3.25. I'm stalking the heck out of that one, if I'm being honest. Individual targets. I would just note that a real interesting divergence in performance. So Ethereum was the worst performer in our stack at -3. Bitcoin Trust was basically flat at 0.19, and then there was the large cap blend, which was the big winner for today. So you're getting a real separation in the individual components in the crypto space. So there's not just one aggregate crypto position. It's really starting to differentiate now as it gets a little more mature. So I should also add that I am really interested in seeing Betty's crypto paper for our research weekend coming up in December. She's putting together her business plan essentially to show us how she has managed in the last couple years to generate $100,000 a year in passive income using crypto miners to simultaneously heat her home, to generate crypto coins, and then help her raise capital to deploy on different marketplaces and brokers, and pegging that to get high rates of interest, and then managing those assets as she follows the variable interest rates and whatnot. And she's done just a marvelous job of sorting it out, and she's going to give us her business plan on how she does that. I'm really excited to look at that. I may send my son up there as an intern just to let him get some work on the farm up there in Winnipeg, and learn something under Betty's tutelage. Squarespace and John Deere underperformed at 1.25, 1.5. Microsoft -1, and TX, the steel company, -1.1. Coinbase -0.7. Apple underperforming. So I get concerned when I see the two stalwarts, Apple and Microsoft, both underperforming the tech sector, which was only down 0.38, and underperforming tech itself. So that is sort of a hedge to lock in the abnormal gains that those two leaders have been able to contribute over the last 6 to 8 weeks. So there is some signs of some warning signs that are baked into the cake here that we need to be mindful of. Okay. All right. Let's take a look at some trades from the fellas. Let's see. So the first thing I wanted to talk about was for Nigel. Nigel had asked a question in Campfire. Nigel was kind enough to have, and brave enough to have, showed us his histogram of his first 200 trades that he's been taken on during the Foundations course. And you can see yesterday's commentary for that. And his note is that gaining proficiency in day trading, the various setups, and he's thinking that instead of trying to trade most of the patterns in several indexes and stocks, it might be better to really focus on one at a time. And in the learning stage, he's finding it hard to hold all the different setups in his mind and to scan for them. And so he's thinking about focusing on the collapsing dragon first and really putting in the practice on that pattern in all its variations, both for the setup, for the risk management, without the distraction of the other setups. And I think that's a good idea. I also think it would mean being able to look at more price charts, so there should be plenty of opportunity. There is no shortage of collapsing dragons. And when the market is where it is, like right now, in a critical state, if the market were to turn to the south, you'd have more collapsing dragons than you could shake a magic stick at, because that will drive lots of hedging and covering behavior and protective behavior. He says, I could also look at the emerging dragon at the same time and invert my chart so that the setup is always bearish. But he makes the correct note that the ED is not the mirror image of the CD. It might be in Forex, but not in equities, and that's absolutely true. And all you have to do is take a look at the sketching that we did on the S&P. And you will see that, let me pull that up again. Price is not symmetrical north versus south. Look how sharply down the collapse happens. So that is a decisive move down, even though it's a kind of only a 4 or 5 day correction. That is a sharp and steep downward move, whereas the upward moves, yeah, you might get the occasional upward move like this on the recovery, but otherwise you get more of a flat grinding upward move, and the downward moves are sharper and steeper. So the emerging dragon is not just a flip of the collapsing dragon. They have different behaviors. So I think his insight and intuition on that is correct. So my commentary was as follows. Hey, you have quite a few reps with the CD already. If you remember his chart, 40% of the 200 trades that he'd taken, so about 80, the most numerous single pattern he's trading is the collapsing dragon, and my spider sense is that those were paying off pretty well. So that's why it's my favorite pattern. I also think that pairing it with the SSC is worth considering because it's the first pattern that happens after one big leg down in a harsh winter. If the SSC works for you, that's good, but if it fails, bam, you're into the CD. So one way to look at that is watch for SSC signals as a setup criteria for a collapsing dragon. And here's what I mean. So we can think of a harsh winter where price rolls down, hits some kind of bottom, and then starts to reverse up, right? And what we would notice is that when that RL10 approaches that dragon that's rolling over, right? When this enters and then crosses the dragon, bang, there we have the SSC. SSC. Supported spring crossing. Well, by the same token, what that creates is an interest in a resumption of this harsh winter. So this was really a harsh winter sell-off that bottomed out right here. And so if we draw that line from the belly of the RL10 across, remember that's where the PSAR flip is going to occur, because while this was moving down, you had a PSAR, and then the SSC happens, and then when the PSAR flips, it comes down to, mathematically it has to, it comes down to where the RL10 bottomed out. And then if the SSC is going to work, well, then the PSAR is going to begin to accelerate, and then you're off into the sniper and managerial exit somewhere up in here. Well, that's fine. So that's when the SSC works. But if it doesn't work, if that thing rolls over and fails, well, that is what gets you into the collapsing dragon. Right? It's this violation of this price level here that is the demarcation line for the collapsing dragon, because you had this horrible downward move. That's the harsh winter. And then you had some anomaly in here where the bulls came in and were trying to prop that up. So if we think of that as leg one, and we estimate the magnitude of that move, if the collapsing dragon happens, then we just clone that move, and it's going to come down this far. So when the collapsing dragon happens here, we're not allowed to be surprised if it puts in that kind of harsh move to the downside right away. And it's not surprising when it looks just like this move. Quick, steep, sharp, painful for all the longs. So that collapsing dragon gives us the biggest move down in the shortest period of time. So from here to there, it's a very short period of time. That's what we're looking for. Maximum return on our risk in the shortest amount of time possible. So we just love that collapsing dragon. Well, if you want to concentrate on the collapsing dragon, and you're looking, what you want to do is you don't want to wait for the collapsing dragon to occur and then have the flags trip and say, oh, collapsing dragon happening now, and then suddenly try to go over to the and say, oh, collapsing dragon, here it is, and then hurry up, try to come in, and then put your entry short, and then you're going to get filled somewhere in here maybe, and now you're suffering lag and slippage, and you're on the wrong side of the movement because the move is already stopping. So what you really want to do is see these kinds of things. You want to see, number one, screen for it's already in a harsh winter, and it maybe has already reversed, touched the, cleared the dragon, and is now rolling over. So now you have this window. If this is the first screen where you filter for harsh winters, and then a bit of a retracement in this window, this would be filter 1, this would be setup 2, and then now you are prepared so that you can get short as that price breach is happening. And that way you're not trying to chase this big move down. You're in it as the CD executes. So as you're setting up your filters and scans, which you can do easily in TC2000, and oh, by the way, that's Danny has that set up already in the TC2000 bundle, which I just got to tell you is a robust, powerful decision support system and trade framing package that incorporates all of my setups in every time frame, and you're not limited to the symbols that I choose, but you can put in any package of symbols that you want. It's extraordinarily powerful and makes beautiful charts, and it's a steal at the price we're offering. I'm just saying. All right, so that's what I want to say to Nigel about his strategy to really concentrate on the CD. I think that's a good idea. I would consider the SSC though, because if you're already there and you see the SSC and you take it and it works, you're happy. Check. And then if you take it and it starts to fail, you scratch it quick, and now you are prepared for the collapsing dragon, so that as that thing fails, you scratch that thing and now it's starting to fail, bang, you're in the collapsing dragon. And so the SSC and the collapsing dragon are kind of mirror images. They're heads and tails. This is if things are bullish, and that is if things are bearish. So if you were going to just pick one, I'd say the CD is the most reliable, because when it breaks, it's large. But then the next one to study would be the SSC. I normally prefer people to start with the SSC because it moves out a little bit slower. It's easy to determine if it ain't working, and when it does work, it's pretty good, and it leads you to the OWL, and later to the ED, and later to the COTA 2 once you start getting a series of those. So that forms a really nice chain to the upside. And the SSC is the entry point, and it's all keyed off that first harsh move to the downside. So I like the SSC as the first long side pattern to study because it's a gateway to the owl, emerging dragon, and kata 2. But by the same token, when the SSC fails, which I don't mind, it leads me to my preferred pattern, which is the CD. So I think those two taken together are the first two that I like. If you can manage both of them, then do so. And otherwise, I would go with the one that feels more comfortable and natural for you. And in Nigel's case, it's probably the CD. But for others within the sound of my voice, it might be the SSC. Okay? So that would be my advisory comments on that. Okay? All right, let's take a look at some of the charts now. Okay, so this is CLF 400 ticks from Luke. CLF. All right, so the first one, Z3 pinch, and he's buying the breakdown out of the below the VWAP. Nice work. This one, the recover, so we only captured this much. I'd like to see more of a capture on this. Actually, this looks like yesterday's. I think I remember seeing this one now. Oh, yeah, I remember this one because we got... So I'm not going to beat you up on that one again, Luke, unless I was going to repeat the commentary and discover, oh, he's saying the same thing that he did yesterday. So, yeah, just capture more, get this in sooner, consider a second position on the Z3. I like the capture, and I want you to re-enter here instead of here, and then I want that then that becomes in the money. This entry should be down here instead of up here, and then you could capture here at a 1, 2, 3, and now you have a nice little chunk of change instead of a scratch. So that's I think what we said yesterday too. So just in case you forgot. Here was the Nike trade, the trade frame setup. Yeah, if I remember, this was also yesterday. Yeah. So maybe we could take a look at what happened on Nike. I think it actually had it bumped up today. Yeah, so let's come back and see what it did. So the Nike trade that was ready to go in either direction had a big gap up, and we're looking at the 15-minute chart here. There was an intraday move possible. If we look at the minute charts on this thing, we would see there was some tradable moves at the start of the day. Yeah. So if we now go to the start of the day here. You'll see that there were some intraday moves possible. So you had a nice big gap up. It fails and establishes a low of the day. You might have taken this one here as an SSC or a kata 2, and that's a tradable move with an exit somewhere in here. So you might have captured this much of a move, which is about $1.50 on about a 50-cent risk. The point I want to make here is that when you have a gap up and then it rolls over, that price action around the VWAP is crucial. Once that breaks, there's downward pressure to make it want to come back to yesterday's close, which is this dotted line. And so the whole day there was downward pressure, and it could never regain north of the VWAP, which began to decline all day. So the downward pressure was there. This first leg down in the collapsing dragon from here to here was possible. That was really about the only tradable move for the rest of the day. It had been hard to make bank in here. You wouldn't have lost any money, but hard to make bank. So this actually sets up an interesting move tomorrow. It finished north of yesterday's close. This was close -1 down here. And then it kept that much of the gap. So it had a plus day, although it didn't have much more follow through after this gap up opening. So in my view, you could put this little risk box right around there, and if it opens inside that box, I would be short at 163 with a belief that it's going to fade the gap and go back to the previous VWAP. But if it can get above this, then it's showing evidence of holding on to that gap, and then add a second position here if it breaks today's VWAP, and then if it breaks above today's peak, this is where I think I could add a third position, and now it feels like it would be a continuation play. So the Nike follow-through offered some small tactical gains, but the swing trade posture is still very interesting. Okay. All right, so that's the Nike trade frame. And again, it has to get above 164.5 for this to be an interesting trade. It actually did that today. So all of these are still in play for the swing value to the top side. Here is Alcoa, a series. All right, so yesterday's VWAP here, and immediately starts moving out. I'd have been tempted to be in right here. Probably would have got this scratch and then stopped and reversed in the usual way. Makes a nice, off that risk box, he's forecasted 1 and 2 units of reward just to get back to yesterday's close. So that's legit. And a beautiful 1, 2, 3 exit to cover. Sweet. A very nice SSC, a great job cutting it. I think that you might have gotten the re-entry here, but still this is pretty good. I like this one because you have the low and the higher low in the dragon, and it's just leaving the river, but it's already crossed the VWAP, which is nice. Now notice how the VWAP, that rising VWAP, is supporting all this action, and that is just beautiful right there. Here's the 1R. That makes this a great sniper, because if this was going to go, it should have continued to go. A great re-entry, a nice fractional gain. I don't mind not re-entering right away, because as you're getting into lunch, you're thinking maybe there's not much there. Reasonable scratch, nice short and cover. Here's a pretty good Kata 2 and SSC even, because you have the swing high. Now you have this. It's already north of the VWAP, and that was certainly possible. You would have ended up getting that little piece. But all in all, this is a pretty good day. There's a lot of good work inside here on the right side of the trade the whole way. So well done. And now Luke with some CLF action for today. Let's see if he learned yesterday's lessons. Very nice breakdown below new low of the day, and an opening range 5 breakdown. So that's pretty nice. And a 1, 2, 3 cover would have been here. Still, that's pretty good. Much better job getting the reversal entry, and he's using the PSAR flip. And this would have been the perfect Kata 2 second entry. But I like the fact that he's waiting to see that it clears the statistically significant level here before he gets the second position in. That's well played. I like the third entry, and I love the sniper, and I love the effort to get short here because we're playing back to this. And really, the whole market was selling off, but Cliff didn't, so he cuts that quick for a fractional loss. I mean, he's got 6R here, and he gives back a half. Fine. Then this is basically a fractional, and then his reversal is nice. Now this time it works for 1.1, whereas when he tried it at exactly the same price level and it didn't work, he only lost 0.5. So that tells you that he's cutting it in time to minimize those losses, and he's becoming more efficient in the capture of the move that was there. I mean, you're not going to see it any better than that right there. And it's covering right and hesitating right at the VWAP. The VWAP, my friends, is a really important price level. You can read more about it if you look at the literature on market profile. You can get an awful lot more on that. The way we use it simply as that marker is, I think, legit. And he gets a nice fractional play there. So, Gold Star today, you fixed all the problems from yesterday. So the flogging was not in vain. Well done. Yeah, Luke, I know that. I remember now that was yesterday's. The earlier ones were from yesterday, but I just enjoyed beating you up so much that I just wanted to do it again. So, so sue me. All right. Let's shift to the daily report now. All right, so we'll go to dashboard number 1. So still bullish, quiet. That's good. A short-term sell-off in an otherwise bullish market is going to now give us these opportunities down here. That is typical. And we're seeing the mid-caps and Europe firing on both channeling and overreaction. The risk Z is right at the crucial state, right along the zero line in here, and now it's ready to go large in either direction, which we've already kind of mapped out when we took a look at the at SPY on the price chart. In that critical state, it can go large in either direction, and that's what we actually like as shorter term traders. So there's that oversold condition now, where the S&P is right on the cusp of becoming oversold, right? So the min pains, these are the ones that are suffered the least. Listen to these names: Home Depot, Procter & Gamble, Disney, and McDonald's. All of the bellwethers, the consumer staples, if you will. The max pains, Nucor Steel, 3M, American Express, Merck, Schlumberger, Eli Lilly. Only 3 dojis today on an expanded range. A handful of auto framers. We're about ready to get close on the NDX for some breakdowns, although we didn't get any today. It's starting to come together. And we're seeing quite a few more 5DDs. So now when I see like DuPont is a 5DD and 3.8, that makes it a high pry trade frame. And if what else do I see as that's the highest priority to me. I like Goldman Sachs as a channeling, a 5DD and 2.2 to 1. And so now if the finance sector begins to recover, you'd expect Goldman to lead the way, and it's already got a nice auto framer capture in there, and the same with American Express. So when you see two of the large cap financial guys in that posture, it wouldn't surprise me on the next page to see XLF being set up nicely. So let's take a look at that in the ETFs. And XLF is reasonable, not quite an auto framer yet, but it's getting close. A good number of channelings and overreactions. We're still inside that 10-day range and no new breakouts as the market is churning a little bit here. We've got gold at 2.1 in the auto framer. Materials is very interesting. It's a 551W and 2.1. And Latin America was in the green today at 1.7% and is still 2.5 to 1. So we like that. So some good opportunities shaping up there. And Brazil is the other one where it was up 3.3%. I think we got to like that. Okay. In the auto framer, again, standard mechanical framing data for things that test out better than 2 to 1. I like Latin America, Goldman, and American Express for the same reasons I talked about before. Nothing on the daily squeezes other than Home Depot, but that could be good enough. And still a large number of things in the red and only a couple green. So American Express trying to show some strength, and Nike showed that little strength. So that was actually that little frame we looked at before shows why you could legitimately be optimistic about Nike continuing to follow through. And Treasuries really stands out with a 291 on the short-term NDX there as a defensive play that's beginning to stand out. So the coyote is licking his chops. All right, that's everything we got for today. Let's get this processed and posted, and we shall see you tomorrow, ready to rock on a Friday and see what kind of fireworks we can get on Friday. Take good care and see you tomorrow.